Hi guys, welcome to Money Theory. In this channel, we're going to teach you the basics of finance and investments. In this video, we're going to teach about minimizing risk in the stock market. So, especially in times like this, we need to evaluate our holdings. Is our portfolio representing the risk that we tolerate? And is this risk exposure appropriate for the current market time? For simplicity, most of these examples are in the context of traditional buying, holding, and selling stocks. We're not specifically talking about short selling or options and derivatives, but you can certainly extend the idea to these strategies. Disclaimer: for educational purposes only, not financial advice, and these are exploration of a variety of ideas and strategies. You don't have to follow all of these necessarily, and these aren't a one-size-fits-all, so adjust it to your own personal needs. So here are examples of why we're in rough times. The index fund has dropped about 10% year to date, and if you're in speculative growth stocks, you might be down 70% in your position. There's been a war with Russia and Ukraine, and there's a massive inflation fears. So remember the phrase, high risk, high return. That means that with potential of big gains also has risk of big losses. And growth companies have risen a lot relative to larger caps during 2020 and 2021, but these same growth companies have also dropped a lot relative to the larger caps during the end of 2021 until now. Another example is with cryptocurrency like Bitcoin. Between September 2021 to November, it rose around 40%, but then recently, between November to now, it dropped almost 40%. This video aged pretty well. It was saying that Bitcoin was going to go to 100K, then 150K, and then 200K. But it's still around only 41K right now. So what should you do? Should you cash out? Being in cash as opposed to stocks would protect you from the market volatility, and this will also give a larger emergency fund. You want to remember this phrase, misery loves company. During a market crash, companies start closing down and layoffs happen, and then you do need money, but your stocks are at major lows, so should you sell now? Or when you want to lend money from the bank, when you need money, they're harder to lend from. Lines of credit closes and lending gets tight, and the qualifications to qualify for loans are a lot harder. The downsides to cashing out is that you're also exposed to inflation. We're at record high inflation with CPI around 7% and the cost of living around 15% increased. You would also lock in your current losses. So instead of giving time for the market to recover, you're just cashing out at near lows. So an option is to consider just having a larger allocation to cash instead of completely cashing out. And selling out of positions that have the most gains to lock in the profit could be another option. Another important thing to consider is to adjust the strategy. Take a break from high risk, such as options, leverage, and speculative growth investments. And you'll be switching from growth stocks to value stocks or index funds. And you can also allocate a higher proportion of cash. The downside is that if you're already in speculative positions, you'll most likely already have losses already. So adjusting the strategies are like cashing out, and you'll be taking the losses instead of waiting for it to recover. Another strategy is called margin of safety. This means that you're waiting to buy the stock at a discount as opposed to buying at near highs. This would limit the downside while leaving room for upside. And it's a systematic method to avoid compulsive buys with FOMO. The downside is that the stock may continue to rise while you're waiting for the fair value. The market is irrational. Even as good as your evaluation is, the market may not reflect the true value for months or even years. Also, the stock may hit its true value and margin of safety in the future, but that price may be even higher than what it is currently. Another strategy is called dollar cost averaging, or DCA for short. This means that you're splitting up your investments over time, and you most likely already do it because you contribute regularly from your income into your trading account or retirement account. If the stock drops, you'll continue to buy at a bigger discount, and this also prevents the need to try to time the market. It's a systematic way to gradually increase your exposure. Here's a visualization of DCA. You're buying equal amounts, and regardless of the stock market fluctuation, you continue to buy in equal amounts. The downsides to DCA is that if the stock rises, you continue to buy at a higher price. Also, if you're investing in a fallen dagger, your investments may just keep on dropping. Peter Lynch famously says that one common investor mistake is that they'll think that it can't go any lower. He says, believe it or not, even a stock that lost 80% of its value can lose more of it, all the way down to zero. Another strategy is to execute stop-loss orders. It's to set a price for where your stock will sell once the stock hits or drops below that price. This would limit the losses and to sell out before it continues to drop. It's an automated trade so that you don't need to watch the market all the time. Here's a visualization of it. You're buying at one price and you're setting an order. So once it drops to that blue line, your sell will automatically trigger. And if the stock continues to drop, you've avoided that further loss. The downside is that it may not perfectly sell at the exact order price. For example, if there is a major overnight drop in the stock price, like with Snowflake, after earnings, it dropped 16%. So even if you try to sell it slightly below the market close before the big drop, your order won't protect you from that overnight drop. Hey guys, I hope you enjoyed the video. Be sure to like, comment, subscribe. And to support the channel, you can join our Patreon for bonus content and Q&A. And check out our other Instagram and YouTube accounts. Thanks for watching.